Okay, so the jobs report is out and it is a disaster, but the stock market was up pretty substantially. So how does that happen? Well, I'm going to tell you. So let's talk about it. This is the Hey Ed YouTube channel. I am your host, moderator, and all-around nice guy, Edward Anderson. I'm not a financial advisor, so do not construe anything that I mention in any of my videos as financial advice. Always do your own research before doing anything with your money. Today, I want to talk to you about, the weird stuff that's going on in the stock market here, right? I got a message from one of my members in my WhatsApp group asking me, well, why would the stock market be up today when the jobs report came in so bad? Because bad news, right? And so I thought, well, this is a good excuse for me to elaborate on a point that I made several times in my videos over the years. And that is the notion that when you're trading or investing for that matter, when you're trying to make money in the market, you have to learn to look at things a little bit differently. You got to take what's obvious and turn it sideways a little bit to know what's really going on. Because there are some times when bad news is good news and good news is bad news. Okay, let's start with what actually happened, okay? Okay, so the jobs report was a huge miss. Okay, the estimated number for a jobs creation was 113,000. Well, they only came in at 12,000. That's an enormous miss. Don't be too impressed with all of these brainiacs, these so-called experts, these so-called analysts on Wall Street. They're not as smart as you think they are, okay? Manufacturing jobs actually went down by 46,000. Private payroll went down by 28,000. The only increase was in the government sector. Our bloated U.S. government got even bigger by another 40,000 jobs. So if you subtracted the government jobs, we would have had a massive net loss in the job market. The only reason why we have, the 12,000 net jobs gained were because of the government jobs. So this is bad news, right? Okay, people are not getting jobs. The job market is not growing. It is contracting. Yet, what happened with the stock market? The stock market was up almost 300 points yesterday. But the previous day, by the way, the market had a terrible time. The market was down huge. So part of yesterday's move might have just been, your proverbial dead cat bounce. And the market did not close at the high of the day. At one point during the day, the market was up over 500 points. And then later in the day, gave a bunch of it back. But it still ended up almost 300 points for the day. So with bad news like this, why would the market be up at all? Okay, now granted, this is a pretty complicated topic, but I'm going to try to boil it down to a bite-sized, digestible piece of information for you, right? Because what I want you to do is kind of conceptualize things so that you can kind of understand the underpinnings of the market, the psychology of the market, the way the market thinks, okay? Okay, so we have to start with the premise that the market likes cheap money. It likes lower interest rates. It doesn't like a high interest rate environment. They want the cost of borrowing money to be as cheap as possible so that their profit margins are as high as possible. Okay, so check, all right? Okay, so regarding interest rates, let's keep the teeter-totter effect in mind, okay? There is an inverse relationship between the strength or weakness of the markets and interest rates, right? The stronger the economy is, the higher interest rates are going to be. And the weaker that the economy is, the lower interest rates are going to be. Because, let's think it through here, okay? When, jobs are strong and the economy is strong, people are doing business. They're manufacturing things and they're growing things, they're buying things, they're hiring people, they're paying people salaries. So that is where, basic economics 101, supply and demand, right, they play a role. The more things are in demand, the more expensive they become. That's inflation, right? Things become more expensive due to supply and demand. So in order to rein in inflation, what the Federal Reserve has to do is literally make life a little bit more difficult for people to do business. That is, in effect, what they're doing. They're trying to make you miserable because they're trying to keep inflation under control. So they raise interest rates to make it more expensive to borrow money, to build that new plant, to buy the new equipment, to hire new people. But conversely, when the economy is weak, They want to stimulate business activity by lowering interest rates so that it's less expensive to borrow money to buy that equipment and to hire people and to meet payroll, et cetera. So there's that teeter-totter effect. Okay, so when you take those principles together, that partly explains why the market had a good day yesterday, because the job market came in very poorly. Now, I'm looking at this in a very narrow way, okay? Because, for the people out there who are looking for jobs, that's bad news. Okay, there's no way around it. It's just bad news. People are having a hard time finding jobs. But from Wall Street's perspective, it sees the potential for lower interest rates because the news was bad, right? When the economic news is bad, the expectation would be that the Federal Reserve will start making it easier to borrowing money, primarily by lowering interest rates. So in aggregate, the Wall Street sees this piece of bad news as good news for them. I mean, for Main Street, it's just flat out bad news. But for Wall Street, they see the potential for lower interest rates, and that's beneficial for them. So in a very narrow, selfish way, Wall Street likes bad news. So when you're trading and when you're investing, the headline is just the beginning of your analysis. You have to look behind the headlines and say, all right, well, what does that really mean? So when you are trading, when you're investing, don't just look at the headlines. You got to think it through a little bit. Now, if you're an incumbent politician, this is bad news, right? So we do have an election coming up here about 3 days from now. So hope everyone gets out to vote. And there are a lot of very weird things that you have to consider going on in the world, right? A lot of things for you to be worried about. Okay, so this gives me an excuse to reiterate the mantra on this channel: reduce your exposure to your bank, acquire some gold and silver, and establish streams of passive recurring income. So that's my little lesson for the day. Please like, subscribe, and comment. Ed Anderson, live from Minnesota, signing out.
Copy that.